but you have maybe a $4,000, $5,000 a month income, something, I don't know, double income, no kids, maybe you got more. Why don't you pay all of that into your HELOC? And then when you get disciplined and you're not overspending on your credit cards, you pay all of your bills with your credit card. I know this isn't Dave Ramsey, right? But I'm teaching you how to be most efficient with your money if you're in a situation where you're carrying some debt. Pay your credit cards a couple days ahead and pay the entire statement balance. And then you're not paying any interest. So I get to use money for 30 to 60 days for free. That's efficient. It's not efficient if you're not disciplined. If you're not disciplined, stop listening to me. Well, we've got a warm, windy day out here today. We might get our first kind of big storm this night. At any rate, I wanted to do a little series. I got a pretty good response on that video I did on the infinite banking system. I kind of became an expert at how to get out of debt without bankruptcy. And I'll throw out a few videos kind of going through that process and kind of leading you to the infinite banking system, because it's a counterintuitive way of thinking that not everybody can kind of wrap their head around. And there's a lot of good counsel out there, Dave Ramsey and stuff, that absolutely rails against whole life insurance, and it's a hard sell, because they just look at it for death benefit. And term insurance is the cheapest thing you can buy. But did you know that 97% of term insurance policies never get paid out? Now think about that. Now more than 3% of the money gets paid out, because the 3% of policies that get paid are higher than what the person probably paid in. But think about it from the insurance company's point of view. Term insurance is pretty good ROI. You're paying in money that you're probably never going to write a claim on. And that's a really good investment on their part. And you're protecting yourself against that catastrophic risk, but probably you'll never use it. Something to think about. But everybody dies. So if you were to have permanent life insurance, you would one day use it. Now, if you just kind of think small and you get a little policy that just provides death benefit, you're paying really expensive insurance, really expensive premium for just a death benefit. But what if you utilized it for all of your cash flow? Everything that you bought, all of your money can go into it. You could theoretically have as much premium as you have income. And I know if you think about that statement, you'll think there's no way. How could you possibly have as much premiums as you have income? You have other expenses, you have this, you have that. Stay with me. So many of you, you've got a few credit cards, you've got this, that. Maybe you're over leveraged in your credit cards. Back in the day, I had 23 unsecured accounts. 23 unsecured accounts. That's crazy. Okay, so I was way over leveraged and upside down and all of that. Now, some of you're not like that, but you have some credit cards, and maybe you've refinanced them on your home equity line of credit to reduce your payment and get out of debt, right? You took an unsecured note and you secured it to your house. Not exactly wise in the scheme of things, but you did it. And that's where a lot of people find themselves. They've got a second mortgage They got their main mortgage, they got a second mortgage, and they took the second mortgage to get out of debt. But they kind of started now you've started putting money back on your credit cards. Really, tell me about it. So, but you have a HELOC. Now, how can you start cash flowing through that HELOC to eliminate your debt? Most of you, it's an interest-only payment. And so you make sure you make that $700 payment a month. So now you got your mortgage payment, plus your $700, payment or something on your interest-only payment on your second mortgage. And now your credit cards are starting to creep up again. But maybe you had more than $700 a month on your credit cards. So now your home equity line of credit's an easier bill. But you have maybe a $4,000, $5,000 a month income, something. I don't know. Double income, no kids. Maybe you got more. Why don't you pay all of that into your HELOC? If you've got a $10,000 or $20,000 HELOC or a $30,000 HELOC, and you've got interest accruing on that daily, and that's a higher interest than your mortgage probably. If you take, as soon as you get paid, you put all of your money into the HELOC as a payment. And then ideally, you have your bank tie your HELOC to your checking account as a, overdraft protection. If your bank account's at zero, it'll automatically draw from your HELOC. And make sure there's not fees for that. No transaction fees. Don't negotiate yourself out of those if they have them. But a lot of banks will have a no-fee checking, simple checking, no minimum balance, and then no transaction fees. So when your HELOC pays an overdraft on your bank account, there's no fee. That's key. And then when you get your money, you make a payment of your entire paycheck into your HELOC. So it goes down several $1,000s, or $2,000 or whatever you get paid. But it's all of your money. And then you write checks out of your checking account that's tied to your HELOC. And it takes a few days for that check to go around the circuit and come back. It's a couple days at least. And so your money's sitting there working against the daily interest of your HELOC. And then it comes out when that check clears. So you've just created a more efficient use of your money. Rather than your paycheck sitting in your checking account waiting to be spent, you immediately spent it by paying down your HELOC. But now it created available credit. But you're paying less interest every single day against your HELOC. Now, if you have credit cards, you want to get your HELOC paid down far enough so that you can pay an entire statement balance off on your credit card. And get to the point where you never carry over your credit card. You pay the entire monthly statement on your credit card. And then when you get disciplined and you're not overspending on your credit cards, you pay all of your bills with your credit card. I know this isn't Dave Ramsey, right? But I'm teaching you how to be most efficient with your money if you're in a situation where you're carrying some debt. Your best place for your money is in your HELOC, and then you pay your bills with your credit card, and then you have one bill a month. It's super simple. And you always pay that bill. And you pay that credit card in full with your HELOC at the end of the month. But then your expenses through that month, when my statement comes from my credit card, all the transactions on that statement were for the previous month and they're due in 30 days. So some of those purchases I'm not paying interest on for 60 days. 60 days free use of money. And then I always pay it, not on the due date. I pay 2 days ahead of the due date. And here's a little hack. Your credit agency is going to look at your bank, it's going to look at your credit card on your due date. And however much credit you're utilizing on your due date is what they're going to say your revolving credit is. Well, on your due date, it's showing 2 months of transactions. The current month and the one you haven't paid yet, or the one you just paid that day, and it's still there. So if you pay your credit card bill a couple days ahead of time, when the credit agency looks at your revolving credit, that payment will be gone, and your revolving debt will be lower, and that'll help your credit rating. So a little hack there: pay your credit cards a couple days ahead and pay the entire statement balance, and then you're not paying any interest. So I get to use money for 30 to 60 days for free. That's efficient. It's not efficient if you're not disciplined. If you're not disciplined, stop listening to me. I'm trying to help you to be efficient. And then as you are, your money's coming in, you pay down your HELOC. And if you're spending less than you make, in theory, your HELOC should get closer and closer to zero. And when it gets to zero, and you really get good at this, then perhaps you even set up a first position HELOC on your house instead of having a regular mortgage. Now you'll have variable interest rate, but if you're paying down all your money every month, if you're using all your money to pay against your mortgage, the actual interest, the volume of interest you're paying may be less than that 3% interest fixed. Because if you're within the first 7 years of your mortgage, most of your payment is interest. They calibrate the interest to be at the front end of your mortgage. So you may actually pay a lower volume of interest with a HELOC that you're paying all of your money into and then gradually taking it back out, than having a fixed rate interest rate. All right. This is getting into an advanced course, but the point is I'm trying to teach you to cash flow through a HELOC to eliminate your debt. And if you've got multiple credit cards, as you create space on your HELOC, you move those smaller credit cards, you pay them off with your HELOC when you get enough space. And then that's a more manageable interest rate. And then you put that credit card away, and you use your largest one to pay your bills with, and you pay that one in full every month. And then you continue to pay down the other ones as you get to them. And eventually you'll get to where you only have your HELOC and you have your one credit card that you put all your bills on, and you pay it every month. And now you're in a situation where if the HELOC gets all the way to zero, then you start stacking up cash, and you need some place to put that cash. So you purchase a whole life policy, and we'll get into that on the next video. So, Game of Trees, we're having fun.
You're playing the game of trees.